To talk more with us about Singapore's economy is Leon Pereira of Spire Research and Consulting. Morning, Leon. What's your growth forecast for Singapore in the current quarter and full year?
Good morning. Well, our growth forecast is actually looking more grim than it was. For the fourth quarter, we expect a growth of about 4.5% year-on-year, and for the full year, we're looking at about 4.9%, which is below the government's forecast. I think we are in a period of weakness. The third quarter numbers were somewhat better than what analysts were expecting at 6.1% year-on-year, 1.9% quarter-on-quarter, but that will not be enough to counteract the effect of a very weak fourth quarter indeed as we go into this period. The manufacturing sector, and that is really the primary issue here, the manufacturing sector in Singapore is struggling.
What about Singapore's GDP growth for 2012 and the risk of recession?
We expect Singapore's GDP growth to be around 3% for 2012. Definitely, we are looking at a weaker 2012 compared to 2011. That's due to weakness in global export markets. Exports are about 23% of GDP in Singapore. And I think even when we look at the financial and business services sector, which is about a quarter of GDP, there are some question marks there. The health of the banks will be partly dependent on what happens in Europe, whether there will be an orderly resolution of that issue. So slow growth in financial and business services and definite weakness in manufacturing because of exports will mean, because of electronics in particular, I think, will mean very weak growth for Singapore, around 3% next year. However, on balance, we feel Singapore will dodge the bullet of a recession. We don't see any obvious triggers for a recession globally and therefore in Singapore. In fact, there are some signs of life coming back into the US economy, and even Europe is being counterbalanced with a weak Southern Europe and a stronger Northern Europe and Germany.
Okay, any other likely headwinds facing Singapore's economy going forward?
Well, the main issue is really the manufacturing sector, which is struggling. And the issue there is not just the global weakness, which is largely centered around Europe and to some extent affecting China exports from Europe. The issue also is, I think, domestic challenges facing the manufacturing sector in Singapore, the restrictions on the hiring of foreign workers, the fact that some exporters are bumping up against their quotas of foreign workers, the strong Singapore dollar, those actually create some headwinds for the domestic manufacturers and exporters. The electronic cycle is in a down cycle. So I think those are really the headwinds, both international and domestic.
Singapore's October non-oil domestic exports dropped by 16.2% on year and contracted 5.9% month on month, with a significant drop in exports to the US and Europe, which you already mentioned. Is this just a blip, though, or is it a worrying trend, do you think?
Well, we do see this as a worrying trend. The contraction was much worse than what we expected. It's not just a year-on-year contraction, but it's also a month-on-month contraction, which shows that the relief that typically comes in from Christmas sales to the manufacturing sector, to the export sector, isn't really kicking in this time. So we do see this as very worrying indeed. It's the worst export contraction Singapore has seen in 2 years, and that's really going to drag down a manufacturing sector that has been rescued by this artificially high stimulus of a high biomedical output for too long.
What's the likelihood of the central bank weakening the Sing dollar to prop up exports?
Well, the next review of the Sing dollar trading ban is due in April 2012. We don't expect on balance that there will be some midterm adjustment or midterm review. The concern of the MAS during this period, though, is probably that the Singapore dollar may be too strong, and to look at possible room for weakening that Singapore dollar in order to revive the fortunes of manufacturing. Inflation is a concern at over 5%, but let's bear in mind that a large part of that inflation is coming from property prices and car prices, which are really driven more by domestic factors. The core inflation rate of MAS, if you strip out property and car prices, is actually 2 to 3%. So the overall concern, I think, would be more that the Sing dollar shouldn't be excessively strong during this period.
Okay, Singapore's electronics exports slumped 31% in October in what's actually supposed to be the festive season. Is the global economy heading for a contraction?
Well, let's bear in mind that even though we are looking at a very poor electronic cycle at the moment globally, the Purchasing Managers Index, which is one of the best forward-looking indicators, is still positive, is still above the 50 level in the US and China, which are the two biggest economies outside of the EU that determine the shape of the world economy. Although I have to say that in the US and China, it's just barely above the 50 level. So we don't see a recession happening right now. I think if you look at electronics, there has been a buildup of inventories, probably to the point of excess, after the Fukushima earthquake in Japan that will take some time actually to run down.
What about Singapore's major trading partner, China? Will its economy see a soft landing?
Well, China, I think, will see a soft landing. We're looking at 9% economic growth for China right now. The concern in the past, I think, was inflation, and inflation is still a concern for the government at over 5%. Inflation is historically very, very high, but I think right now the concern of the Chinese government is not to excessively restrict credit to enterprises and damage economic growth. Exporters, particularly in southern China and maybe in central China, are being affected by a weak global export demand situation. And if you look at some indicators, for example, weakening demand for steel and cement, weakening prices for steel and iron ore, it would seem that there is a slowing in the economy. So we expect the government actually to pull back a little bit on the cooling measures and engineer a soft landing of about 9% GDP growth for this year.
Let's talk about the neighbouring economies of Indonesia and Malaysia as well in 2012. Do you see a better performance than this year?
Well, for Malaysia, we see performance in 2012 as probably being flat. I think this we're looking at about 4.8% GDP growth. Next year, there will be more weakness in global demand, and Malaysia is a very globalized economy. It's rather export dependent, so that will be actually on the downside. But on the upside, I think we will expect more government spending, government stimulus, because next year will be an election year. So on balance, I think the economic growth will be flat. For Indonesia, I think the picture is more positive. Most of the observers and most of the companies that we are in contact with are rather bullish about the picture in Indonesia. That is largely because of consumer sentiment, which is very, very positive. There's also some boost coming in from foreign direct investment and also from commodities exports. So the picture in Indonesia will probably be higher, or at least the same as about 6.5% growth that we expect for this year.
Okay, thanks very much indeed for your insights, Leon. That was Leon Pereira of Spire Research and Consulting.